You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor podcast series.
Welcome back to this week's edition of the Systematic Investor Series with Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, where each week we take the pulse of the global market through the lens of a rules-based investor. And for long-term listeners, our conversations are intended to keep you focused and inspired to continue your trend-following journey. And if you're new to the show, our hope is that today's episode will trigger your curiosity to check out our back catalog and all the past episodes that you may have missed. Jerry, Moritz, good morning, good afternoon. How are things where you are today?
Good morning, Jerry. Good afternoon, Niels. Doing fine.
Cold here in New York City, but a lot of fun stuff going on. Just trying to weather the stock market crash this week and stay inside and hunker down.
Yeah, it's probably one of those weeks where we will have enough to talk about, I think. So let's see how it goes. Kind of a quick roundup. I think most people listening to us today know what happened last week in the financial markets. From what I can tell from the headlines just this morning, it is in fact the fastest drop, larger than 10% in a 7-day kind of trading period from a new all-time high in history. But it wasn't the only records that were set last week. Interest rates, the 10-year US notes declined, the yield down to 1.13, dropped by 25% to hit that all-time low of 1.13. And of course, the 30-year bonds also made new record lows. And I think that is kind of important because it sends a different message to that of the equity markets, recent kind of hitting very high valuations, certainly compared to the last 20 years. I mean, bond markets are basically saying that economic growth and activity is going to be somewhat muted over the next 10 years and that a mere 1.13% yield will be a fair return on investment. But I don't think it was the only surprises we had during the week. We saw things like gold and silver get hit for the week, actually, which is not kind of the safe haven behavior some people might have expected. But I am interested to see what caught your eyes, Moritz, first, in terms of market action, not least, of course, your own, but also just in general, what you found interesting.
Did anything happen last week?
I'm not sure. Some people say it was a busy week.
Just checking. Down 4%, no dramas. So finally, I put this on Twitter, finally outperforming the S&P 500, which is down more than 10%, right? So
great stuff.
Pretty happy about that. But obviously the long positions in equities, they were a drag. None of those have worked. I got stopped out of quite a few topics, S&P, SMI, Eurostoxx, I think I remember. But of course, the bonds, they kind of like kept me alive that week. The price move higher in US bonds, Canadian bonds, Australian bonds, all over Europe has been very, very strong. And I've been long, so that's good. I've been short gold, short oil, which helped. But like you said, Niels, long pretty much all the precious metals, not only gold and silver, but also platinum and palladium. That didn't work. I know platinum and palladium, they aren't that much of a risk-off asset as gold and silver, but it was kind of surprising to see that gold and silver were selling off pretty much every day this past week, in spite of the fact that the equity markets were tanking. So no safe haven here. Maybe they were the ATM and maybe people had to liquidate them in order to meet margin calls or, get cash for other positions and cover losses elsewhere. We don't know that, but it caught my eye. What also caught my eye was that Bitcoin isn't the safe quality asset that we always, think it is. It moved down about $1,500 or so from 10,000 to 8,500. But Bitcoin's Bitcoin. It's this uncorrelated thing. So we'll see what happens. Anyway, -4 for the week, slightly up, about flat for the year, 30 basis points up for the year. kind of like a reset back to January 1st in a way.
Not bad, I think. I mean, I think that's pretty good for a trend following strategy. We didn't fare as well, so we're down a little bit now for the year, and also down in February. But these are the things that happen, and as I'm sure it comes as no surprise for the people listening to us every week, that when you do have, in our case, mainly equity markets that kind of entered last week very close or at new highs, that's going to mean that we're going to be having very healthy long positions in those markets. And kind of as a medium to longer term manager, it can take us several weeks, even if we're losing money. It can take us some weeks to unwound positions like that. But we also have some other things that we build into the model that helps us from time to time accelerate our exits. Something we discovered 7 years ago, and actually they did get triggered this week. So we did see also, like you, Moritz, quite a lot of reduction in risk, in equity risk in particular. And of course, long bonds like you were, long the metals, which didn't help, but somewhat short energies, but not quite enough to offset what happened in equity. So we had to register a little loss in February, and as I said, down a handful or so for the year so far, which is not too bad. Certainly not. It didn't feel. And it wasn't in terms of the numbers, and it certainly didn't feel nearly as bad as we saw in February of 2018. But I am expecting, when we see the results come out, I'm expecting certainly that some of the short-term guys have done really well, because it was, a breakdown of equities, but it was a consistent breakdown. It was like 4 or 5 days in a row. And that should be really good for some of those strategies. Certainly some of the numbers I've seen suggest that maybe not so much in the short-term traders index, but some individual numbers. And that's great. I mean, all power to them. That's kind of the role that I see that they should play in a diversified portfolio. We are there to provide the long-term benefits when you have longer-term crises. But in the short term, it's more random than anything, whether we're going to start out by making money or losing money when you have these things happening. And this time we were on the losing side, but nothing, as you say, no drama. And it's nice to have a plan every day. You go into the markets and know exactly what you need to do. What's interesting to me, and maybe this will come up in our conversation later on, is of course that we've touched upon in our previous episodes this thing about how much money today we see in passively invested funds, and those kind of investors and their reactions and their sentiment will be interesting to see, because they can certainly provide a lot of selling pressure. And I guess the only thing that really, not the only thing, but one thing that really surprised me this week was there was a headline in Bloomberg saying, "Don't blame the quants for the sell-off, blame the humans." I didn't expect that, so that was nice.
Yeah, we're not human.
What about you, Jerry? I mean, equities have been in the epicenter this week. So since you have, different equity exposure than Moritz and we have, so I'm really interested to see how the portfolio, or what happens during a period like this.
Well, in contrast to all the indices being in big uptrends, my stock portfolio was only maybe half the stocks were in an uptrend. So I had sort of smallest positions, but there was no diversification at all this week. I had one stock or maybe one or two that had some strong days, believe it or not. A drug company and Zoom.
Oh, yeah, of course. Yeah.
So I'm not sure why, and I think Zoom kind of crashed on Friday as the market sort of rallied late in the day. But I think it's a lot of lessons to be learned from this week. Pay attention to the trends. I think it was so easy to sort of, if you're more discretionary, or even in your own head, you could be following the systems, but still thinking, oh, this is kind of overdone. It's extreme. It'll bounce back. These are sort of dangerous thoughts to have. especially if it leads you to not have a system or not to act on those, not to act when you should, and your system is giving you indications of cutting back on your trades. But so I think another good lesson is sort of like you said earlier, sort of how unprecedented these moves were, and first time in history it's taken 6 days to get into a minus 10, or I think we might be in a minus 15. So once again, something we've never seen before. The historical performance in the past is not very useful for us today, as far as what to expect and what these markets can do. And even what we've seen this week may not be a great lesson of what could happen in the future, because anything can happen. And unfortunately, also anything can happen with our approaches, our systematic performance of our systems, that they could look a lot different than they've looked in the past, because they're being applied to data that we've never seen before. So it's kind of, and I'd say the third thing is another example, unfortunately, of being able to blame trend followers for not producing any sort of crisis alpha, because of not only did we lose in the stocks, but we lost in other markets as well. So it was just good to be short, and I didn't have enough shorts. So whatever you could find to be short was a good idea, and get out of the longs as quickly as possible. So I was talking to someone earlier, and I was telling them this is sort of unprecedented, and they said, how about 2008? I mean, that was unprecedented, and the stocks got crushed. Why didn't, but you did well in 2008. Why not this time? Like, oh, well, different chart patterns, I guess.
Yeah, but also, I think we've touched upon this many times, and I think a lot of the people listening to us is fully aware of that. Our systems are not designed to provide any protection in a situation like this. If it did, it would be from other positions, but from the actual, if you just look at how we would be trading the equities in the last period of time, we have to be long. We have to be significantly long, given what's been going on in the market. So when you do get a quick sell-off like that, we give back part of that profit, all of that profit. That's just how it's meant to be. There's nothing wrong or right about it, but it is what it is. So I think the more people take time to understand that that's how it's meant to be, and there's nothing wrong. I think that maybe some of the headlines will focus on other things than CTAs not providing crisis alpha because we are down for 1 week. I saw a chart. I'm sure it must have been some kind of log chart or whatever, but there was a guy who posted a chart of the Dow Jones in the last 100 years, and of course this week you can't even see as being anything. There's no drama at all when you look at the chart, but how it felt during the week, and I'm sure a lot of people felt it was dramatic. And the other thing that to me makes it probably more worrisome is that I think we talked about this last week from some of the research that Chris Cole has recently published, that 72, 73, 74, thereabouts percent pension funds in the US have 72 to 74% exposure to equity type risk. So for them, that's dramatic, right? Without a doubt. So for any long-only strategy, this can turn out to be something much worse than what we've seen so far. So how did people react on social media? What did you find of interesting stuff that we can get our teeth into today?
Well, I probably stayed away from social media more so this week than ever. Just preoccupied with what was going on and trying to pay attention to that. So it's a light week, but I did tweet that same article that you saw that said, and it got a lot of responses, which I should read some of those. I haven't, when I talk about my tweets, I don't really think too much about the comments. I don't get many comments, but I got some comments on this one. 6 days. That's all the time it took for the S&P to fall more than 10% from a record into a correction. That's the quickest turnaround of the sort ever. And my comment was the present is not constrained or influenced by the past. And Moritz commented about beating the S&P. One person commented, has market structure changed enough that trend is no longer a great insulator from these types of moves? Sam said the insulator is diversification into trends in other markets. Both bonds ripped this week. And so I think those are pretty two good comments. I think it was really good to stay in that bond trend and not be too eager to get out. That thing was very nasty sell-off. Not nearly as bad as the stocks, in my opinion, but hanging in there long term and suffering that drawdown, then surprise, surprise, they come back gradually, and then a great week to have a lot of bonds long. So that worked pretty well. And I do think that there is no market structure that is going to do well for that particular sell-off. There's very few ways of making money for the long-term trend followers. What happened in the stocks this week, and I've seen that back in the 80s, 90s, all through my career. That exact same crash scenario where you're just sort of helpless, and I do think it's better to trade a lot of different individual stocks because they didn't have that particular look of the S&P. So that's pretty dangerous if that's all you have going on. And but this is not unprecedented in any way. It's just discouraging, I think.
Yeah, of course. And now we're waiting for next week where we might get some response again from the central banks. I mean, the big question, I guess, that also Chris Cole raises in his report is, will the buy the dip strategy that has worked so well for the last 10 years, will that continue to work? And I guess every time we're at this crossroad, we kind of ask ourselves, and I'm not quite sure what the answer is going to be this time, but only time will tell. And but at least we don't have to worry about it as such, since we have rules to follow. So what else did you find interesting in terms of articles and stories?
Well, I just wanted to go back and mention, I had a comment about gold and silver. So I think that I was getting some calls yesterday about rumor about the Fed stepping in and lowering rates to help the market. And so I think this is probably what was going on in the metals, just that no inflation and no reason to own these metals anymore, just move everything into bonds. And I thought that was kind of interesting about how that was, because I think initially when the market started selling off last week, gold did pretty well, silver. So I thought that was pretty interesting how in the middle of the day, these fundamentals are flying around and I'm so confused and I'm not paying attention to them except just gossip sort of. So I thought that was kind of interesting. I guess that's what hit Bitcoin as well. And then I was thinking, why doesn't the Fed just step in and buy S&Ps? That would be more fun for me rather than going this indirect route of lowering rates when the bond market itself is sort of saying, the free market, the bond market is saying, hey, Fed, why don't you lower rates? So I thought you would think that was funny.
Well, in wasn't it in December 2018 when equities were having a really rough time that it turned out, I think it was published that the administration in the US had called whatever the 7 banks. I don't know if they're the ones who are called the plunge protection team, but they obviously came in around Christmas, and from there on it was one way up. So you never know.
Yeah, I remember when Facebook went public. I was watching Facebook that day, and one of the banks, maybe Goldman, it took them public or whatever. I guess they had an order. They had an agreement to not let Facebook go below the IPO price. And so every time it hit that low price, it would just bounce every single time. It was just a straight line across. It could not go lower. So that would be fun If
Yeah.
I think the market was sort of saying we would like a response from the government. I don't care if it's cut rates or whatever, to settle everything. And so late in the week, they finally figured that out, and they said a few things, and we didn't get another bad day. So it's kind of interesting how it all worked.
Well, it amazes me with all the everybody's calling for the government and the Fed and the central banks to provide a bailout to the market, and yet at the same time, we're here as capitalists trading those markets. And really, as a pure capitalist, I didn't want to see any of those interferences with a free market, but it happens over and over again. And as far as buying equities is concerned, I mean, we only have to look to Japan. About half of the equity market is owned by the BOJ. It's mind-boggling, the extent to which those interventions go, and it doesn't seem to stop. So let's see what's next. I mean, who
Yeah, I
knows?
think that's the problem. It doesn't work, and it definitely doesn't work in the long
Exactly.
run. Right. And I think that the point I was trying to make was that just say something. Would someone say that they
Right.
have a plan or they're in control, whether it's going to work or not? It's kind of like when you feel kind of vulnerable as a child. If your parents just say, "Hey, it'll be okay," it may not be okay. But if someone would have just stood in and said, "Hey, I think this is going to be fine. I mean,
Right.
I'm working on this," and so the market's like, "Oh, okay, then we can stop going down." So that was just my interpretation of last week, way off our usual topics of let's just keep it to the trend.
Right.
But
I mean, this past week, what it reminded me of is it's the emotions and human beings driving those prices and those markets. I mean, 10 days ago, equities were making new highs and everything was suns and roses, and nothing could be bad. And then all of a sudden, this fear about the virus gets the better of everyone, and it crashes immensely in such short time, right? So it's again proof to the fact that there's always this human emotional thing that gets the markets crazy and drives them to strange levels, both to the upside and to the downside.
But it's not. I would add to that, Moritz, and say it's not just sort of the human emotion. I think it goes much deeper than that. I think it's really human behavior, right? Because yeah, I mean the markets have reacted, and that's emotional. But if you just look at what's happened this week in terms of changes to behavior, I was telling Moritz before we started the recording, Jerry, that I was meant to go to Milan this week on business, and but as this story broke out last Sunday about northern Italy being kind of the epicenter in Europe for Corona, it didn't take me 24 hours to figure out that I didn't want to go to Milan, right? So I spoke to someone on the phone yesterday who was on a plane from London to Milan Thursday evening. There were three other passengers. There were four in total. So human behavior is interesting because if we start changing human behavior, or humans change their behavior based on, for example, in this case, the coronavirus, that can have really big impact. And of course, we as trend followers have argued this for years because deep down, that's most likely why our strategy works and the efficient market hypothesis isn't working all the time, at least. So I think it's incredibly powerful, and it's a very good example. And I think it's a good reminder of why people should have something in their portfolio that is kind of, created to adapt and benefit or profit from these impacts that are completely unpredictable in many ways, but will be reflected in price.
Yeah, I just it's testament to the fact how quickly things can change, whether that's emotion or behavior. But it appears to me that, like I said, 10 days ago, you probably would have ruled that out, and then all of a sudden there's this awareness that it could be bad and maybe worse than we thought, and then the behavior changes so quickly and so dramatically. It's amazing.
You told me something about the German authorities, Moritz. What was that? About 60% would catch this, or what was that?
Yeah. So people can find it on Google, and it's not only about Germany. It's some specialists, they predict that 60 to 70% of the population, they didn't say world population, but they said, of German population. So I guess it's probably true for other countries as well. 60 to 70% of the people are likely to be affected by the virus within the next 2 years. It's just the hope is that it's not going to be happening to everyone at the same time, because that would be very problematic to infrastructure and hospitals and all that type of stuff, right? But it's you have a higher chance than a coin toss to attracting the virus and become infected within the next 2 years. Maybe in a year's time, maybe in 1.5 years' time. Who knows? I know nothing about that topic. I must say, when I open the favorite websites which people read these days, the news websites, of course, I mean, for them, they are making a killing out of that, right? Crisis and bad news, they sell so well that whatever website you open, the headline is the virus. The second story is the virus. The third story is the virus, and so on and so on and so on, right? So it's really nothing but, and it's breaking news and it's rolling banners. And I'm sure there's a lot of exaggeration in that, because we know that from reading the news and having people report about the markets. Okay, you can say, let's be very careful and cautious about this virus. It's really a bad thing, but of course it attracts clicks, right? When you say 60 to 70% of the population will at some point, attract the virus. And it, like you say, it changes people's behavior. I mean, here in this country, normally supplies there's no shortage of anything. Everything works, right? Kind of like in Switzerland. And now you see people going into the supermarkets and buying the ravioli cans and the toilet paper, and there's nothing left. They're hoarding it, right? So it's the end of the world preparation going on. So like I'm saying, all of this happened within a couple of days. And it's not a gradual change. It's kind of like a tipping point that appears to have been reached. And, on the cusp, people have just changed behavior.
Two small comments on that. To your point, I heard from some family who lives in Singapore that actually in Singapore, things like that is now rationed. I mean, you can't just go out and buy toilet paper. It is rationed. So, I mean, that's pretty severe, right? And secondly, about the funny thing about the news kind of wanting to, I mean, obviously this is a big story for the news. Funnily enough, in Denmark, the first coronavirus case was actually someone working at the news. So the whole thing got, they have to self-quarantine themselves, So they had even more to talk about on that front. So, yeah.
And, price and trend, those masks we were speaking about earlier, normally the pack's $5. They're now selling here for 97 euros. So if you want to get 5 masks, 97 euros, there you go. So it's 20x the price.
Almost as much as these remotes we bought, Jerry, and we shipped to the US for the Apple TV.
Yes, those remotes are showing up. More of them are on eBay now, so I hope that that price is coming down. But I see them more and more. So, and I think another thing is that, yes, I mean, it's crazy behavior and it's a lot of panic. And I heard that another reason that stocks were going down early in the week was based upon some of the political people here in the U.S. about who's running for president and who's in the lead in the polls. And so this one person who's in the lead in the polls, he's going to be bad for the economy. And so who knows? But I think that the danger is that, on one hand, I don't think that this stuff is sort of predictable, but it could be right. You just never know. And that when the market, it was logical and it made sense when people panicked and the stocks got crushed a few times over history that we've seen, and then everyone calmed down and the market went back to new highs. But it did not do that in 2008, so it doesn't always do it, and it's It's illogical sometimes, and it is people panicking, and it will reverse and go right back to the highs, and buy and hold will once again resume, and we'll all be made fun of for doing anything other than buy and hold, or it could keep going. But so price is doing what it's doing. I don't think it's necessarily right. I don't know if it's going to be right or not. And so if the market goes back to new highs and all the stocks I had to get out of go back to new highs next week or start back to new highs, then no, it was not. Price was not my friend, and it didn't do a good job. But it is the reality, and the back test says even if when this does happen, net, it's still profitable just to pay attention to price. And there's nothing that's going to keep you out of trouble, even though you're going to get yourself out of trouble more often than the trouble even really exists.
Yeah, absolutely. But there were some other articles, as far as I recall, that came up in your Twitter feed. Before we go, we got quite a few questions because last week we had to postpone some of them. So we got a few questions lined up.
Yeah, let's talk about this one you brought to my attention. I guess it was a Negative Barron's article about CTAs and futures and trend following. And AQR had a comment, I guess Cliff had a comment about this article where he says, things you're quite convinced are long-term edges are themselves low, sharp processes. They should be judged on their economic reasonableness and as much evidence as possible, as real-life results are sadly almost always too short for the task. Hopefully you'll find many edges. You can use good risk control and discipline. Keep an open mind that things may have changed, but not so open that your brains and your money fall out. So, and then he ends it by this famous quote, which is apt for this week, which is, if you can meet with triumph and disaster and treat those two imposters just the same, you'll be more successful. So I think having kind of an even mentality this week of these losses in these markets is very helpful. I don't think I would have been this calm or kind of just resigned to reality 20 or 30 years ago. So some of the mentality that you have with crazy markets and losing money and wiping out the year's profits very quickly, I think may just come from experiencing the alternative, which is freaking out about it, which doesn't help either.
Yeah, I mean, his comments, first of all, always very well written. But his comments, maybe to put it into context, it was a response to a Barron's article where I think Barron 3 years ago had them on the cover, AQR and a big group of AQRs, and the headline was, brain power or something like that, and just showing how, talking about how well they were doing and all of that stuff. And now, the article that they wrote about them again was AQR can't even beat, the risk-free rate of return or something like that, whatever it was. So, and but of course, I think what Cliff is saying is absolutely true. And of course, we shouldn't get too excited when things are working out really well. Neither should we get pessimistic when they're not. We need to believe in the long-term process and benefit. And I can't remember, actually, if we talked about this already. I can't remember if I mentioned this. But if I look back on, for example, the last two big equity crises, and I'm using the MSCI as the index, and I look at our own performance, but I'm sure it's going to be the same if I took your performance, Jerry, or Morris's for that matter, or any of our peers. Even though both periods, which of course is the tech bubble and the financial crisis, even though both periods provided very substantial positive performance, for us, they didn't necessarily start out in the same way. So in one of them, the trend following strategy made money straight away, but the other one, it took quite a few months before it really got going, as the crisis, as the losses in equities got bigger. So you just don't know exactly how price action will turn out, and therefore how our models will respond. So you just need to keep at it. Stay with the stay with the rules.
Exactly. I mean, at least we have that plan, right? I mean, now that this week I've got kicked out of most of my long equity positions, I'm fully expecting the market to scream higher on Monday, and I'm no longer long. I mean, this would be the normal behavior, right? But then again, I guess you need to take that on the chin as well, and I will if it happens. But like you say, Niels, it may take a while, maybe, another week, 2, 3, whatever, and it dances around, but eventually maybe it becomes not only a correction, but a longer term downtrend. And then we will be on the right side of that trend. And we will be making money then, hopefully. But if it, just turns around in a V-shaped kind of like recovery and the S&P is up another 10% next week, well, then I won't be looking that good.
And I think another thing is that putting yourself in a situation to be able to follow these rules and enjoy life and enjoy your process, it's so mandatory to be fully diversified and have shorts and not be overweighted in a sector or not have too many precious metals on, or because that's the flip side of having too many bonds on. If this time that was probably a pretty good trade, but a heavy concentration into any one sector that's all moving together, just like the bonds do and just like these precious metals did, that's something to be aware of. And so when I look at all of the issues, and I wrote myself a note, like go through last week, this week, every market, every trade, and just look at and see what is anything that stands out. I think that's the most important thing, is that the big problem in stocks is if you had too many on. I mean, that's really it. I got crushed in the metals, but I didn't have a huge position because I scaled them back because they're all, in my opinion, somewhat similar. But if I have a complaint, it's usually going to revolve around too much risk, or maybe even overall risk. My vol on a daily basis, it's just I come in with too many. My positions are too large for my comfort zone or my clients or whatever the case may be. But I think trade small goes hand in hand, and trade appropriately to what you can handle, have some real true diversification, like we talked about last week with Harold DeBoer. Some of these trends, they're expressed in 10 different markets, and it's the same trend. But sort of sticking to a system, being able to stick to a system, kind of goes hand in hand with your leverage and your quality of your diversification.
But also on that point, Jerry, and I think that's what worries me, is that we talk about diversification, we all embrace it, we all live it. But then when you look at the much bigger pools of capital, I actually think that there is less diversification today than there were 5 years ago, because they've all been chasing yield through equities, and then recently they've all chased equity yield through less liquid equity strategies such as private equity and so on and so forth. So, I mean, I think there is definitely enough build up, and maybe it's not this time, maybe it's another thing that triggers it, but I would not be surprised that we're gonna have at some point we're gonna have a massive fallout again, because I think just the makeup of the investors' allocations are getting very concentrated. So at some point when you have enough pain, then people start voting with their feet, and that's going to, certainly in the passively managed products, that's going to lead to even more pressure on those markets. So we'll see. Anything else, Jerry, you want to bring up from your side, or should we jump to some questions?
Maybe one thing before we do the questions, I wanted to bring this up because I found it amazing that, the shorter term trend systems, and I think, Niels, you mentioned it earlier in this conversation, some of them had a really good week. And so maybe a shout out to 40in20out.com, our friend Andrew. He's posting his results on a daily basis, and he was up every single day this week. Month to date, 12.51% up. Year to date, close to 20% up. And, most of that P&L coming from newly initiated short-term positions, short the equity indices. And, I'm not short the equity indices. I got stopped out, but I'm not short. So, it shows that there's some real power in those short-term systems.
Yeah, but it also shows that there's power in diversification, but diversification doesn't always mean market diversification. It's certainly as much time frame and methodology and all of that stuff. So yeah, I completely agree. So good point. All right. First question that we missed last week is from Brian. Brian writes in, Jerry believes and emphasizes using the same rules for all markets. Who are some of your past guests who promote using different rules for different markets if it improves performance? So, I mean, from my point of view, I don't recall whether anyone has talked about using different rules for different markets. That's not to say that they wouldn't do it, but I think most people in our space, certainly in the trend following space, probably uses the same rules across all markets. But I think in the short term space, I think it's completely natural that you develop market specific models. I think that would be the norm. But in the longer term trend following space, I don't know anyone. Have you come across anyone?
I have. I'm not going to mention any names, but I know a bunch of medium to long term trend following firms and people who have different rules for different markets and trade them in slightly different ways, different time frames.
Does it work?
Well, it's okay. Yeah.
Okay.
Look, it is working now. We're saying we don't want to do that because it opens the door to too much curve fitting and it destroys our sample size. If I'm using a different rule for every single market, then I will end up having even less trades than I already have. And I wish I had more trades in my portfolio with all the rules being the same, right? So I'd like to maximize that sample size. If I'm not using the same rules, then I'm minimizing it. But I don't want to judge on that. It's does it work? Yeah, it works, but maybe it has worked not because the rules are different, but because the markets have been the way they have been in the past 30 years, and it wouldn't really have mattered if you had the same rules or slightly different rules. For me, it's more the point about I don't want to do that because I'd like to have a clean statistical sample size to analyze. And this is where I stop my thinking about it. And I would, by the way, Niels, do it in the same way also for a short-term system. If I traded a short-term system, then I also wouldn't use different rules for different markets there, only because it's short-term. It's for me, the system has to be uniform and work in the same way across everything, across the portfolio.
Yeah, and I think one way to analyze that is to look in sample, out of sample, to see if your corn system is the better, that works the best in the out of sample data, or what works better, just the system that works the best over all the data. So I think, but I think the human inclination is to do that, to fine tune it. These markets have personalities, they're different. You can't tell me stocks don't behave differently. I've heard this a million times. And so I think that, and I've also heard recently that people would say things like, well, now I have enough data for commodities. And this is almost like a quote, that I will optimize the commodities data. So that sort of flies in the face of what Moritz said and what I quoted earlier, which is, from Cliff Asness, which is you just never have enough data. And so I'm not really sure. I'm surprised right now that it's sort of a known idea that short term, of course, they do market specific systems and rules. So I didn't even know that. But I think I wonder if it's sort of a trade-off between being ultra-conservative and careful and responsible, which may be unnecessary, as it is most of the time in life. Go ahead, have a good time, loosen up. Probably doesn't hurt most of the people most of the time. But I guess the downside is, if we're correct, I just wonder if we changed our mind and how much better the performance would even be. So to me, it's just a trade-off I'm not willing to make.
Yeah. Well, speaking of changing our minds, Jacob writes in with the next question. starts out by saying, thanks for discussing my last question in an otherwise volatile and great show. The question this time is when to change system rules, i.e., are there general rules that can be used in order to indicate when one should be changing the rules of one system? What are the criteria to determine when to stop trading a system? I guess it's a highly subjective issue, but it's an important topic nevertheless, especially for the trader with a relatively small account size. He won't be able to diversify over a large set of subsystems and would otherwise improve risk-adjusted returns and the ability to research, add, subtract additional systems. Cool, Moritz, I'm gonna start by asking you this.
Yeah, the all important question: when do you stop trading a system that apparently has stopped working, but maybe you can never be sure that it has really stopped working, right? So there is, for me, I've said this before, no objective hard criterion that would tell me now it's time to stop. This is not how it works. It needs to decay over longer time periods, much longer time periods, because as Jared just said, we're lacking the data. We don't even have enough data. So determining that a system has stopped working itself, by definition, then requires a lot of time before you can really, jump to the conclusion and say, I'll turn it off, or I'll tweak it, or I'll change it. So it is completely subjective. And I think that experience plays a tremendous role in that process, to keep you at bay, so that you don't fiddle around with your rules all the time. You're in a drawdown and you change stuff all the time. That's not what you want to do. You have to be steady with those things and love your system, follow your system. And then, of course, if for years and years and years it does not work, then hopefully you've done some research in the meanwhile and you know what you're going to change and how you're going to change it. But then it's probably a good time to make a switch. But other than that, really, it's everybody's doing that in a different way.
Any thoughts, Jerry, or are we all on?
No, I have no idea when you should switch. I have a feeling that it's changing my parameters around is probably not as important as coming to the conclusion that the core idea of following trends and taking small losses and paying attention to price only, having your system give you an overwhelming opportunity to profit from the outlier trades, doing longs and shorts and being maximally diversified. I think that's probably likely to not work, or work, and getting that question correct is probably more important than tweaking my look back or my parameters, my moving average parameters, etc. So I think that, as I've said before, as I just laid it all out, which one of those wonderful ideas are you going to abandon? No more shorts, no more small losses, no more mega profits. I'm going to switch all of this around. Too much diversification is bad. Can't pay attention to price only anymore. You have to do quantamentals. We haven't talked about that, but I read a lot about quantamentals, which I badmouth, but not really sure I know exactly what it is, or if it's a marketing slogan or whatever. But so there's so many elements, the 10 commandments of systematic trading, the characteristics of systematic trading that we extol their virtues. But is it possible that you have these goals, and they're all worthwhile goals, that they're just not attainable? And so the best thing possible is this S&P 500 index that has about a 8 or 9% average return and a 50, 60, 70% drawdown, and it's got these rules, and it's momentum-ish based, and so that's all any of us can do. So I just think that I personally would be one of the last people to throw in the towel and go for that, although that could be a mistake.
Yeah, I think it's a good question, and I agree with what's been said already here, Jacob. But just maybe as an illustration, all I can say is that on our side, going back 45 years, I would say we've made two major changes to the model, where we basically made some new discoveries that I would say is completely brand new that we have added. and so I think it shows that it's rare that you find something within trend following that is so different, so new, so much better, that you want to, change it. And that also, in a sense, goes to the same way that if you have something already like that, it's probably going to keep working, maybe not all the time, but to stop it and do something completely different, I think that would be very rare. Small changes, small tweaks, sure, that happens on an ongoing basis, but really big ones, very rarely on our side.
And the bottom line to all of this, it seems, is that people have bad memories, because no matter what you say bad about the S&P system and buy and hold and the 8% or 9% and a 50, 60, 70% drawdown, it's just all forgotten at some point, because it has its day in the sun, and this day has lasted a long time, and people forget all of those nasty periods. And as it relates to making a decision, which is I'm going to put most of my assets in that, nothing can really, it looks like it recently has beaten it, and it is making money. So hope is still out there that any sort of problems that people have these days with CTAs, they'll forget those as well when our strategy and our level of diversification becomes more in favor.
And by the way, I mean, I don't have the facts in front of me, but I think the stats are that every single year there will be a 10 or 15% correction from a high to a low in equity markets. I mean, that's not unusual. Maybe that's what we saw last week, and nothing more happens. I mean, we just don't know. Yeah. Next question up is from one of our good friends, Adrian, who were with us at our live event in New York. And by the way, let me give a shout out to everyone who was there, because we see in the private forum that we set up after the event that people have been really busy improving their strategies and delivering some really great breakthroughs. So maybe we should consider doing one of those live events again, if there's enough interest, of course. We'll see. Maybe people will email us if they're interested, and then we have something to consider. But Adrian writes in, and he has very specific questions. I think maybe I'm the one who does it the most. I'm not so sure whether Jerry and Moritz does that, but it's a question about signal strength. What does it really mean? How do you define it? And so I'll go first on this, and then you can say whether you have anything in your vocabulary similar to that. But signal strength for me is really like, if you have 10 systems, for example, and they all point to being long, you're fully long. So your signal strength is very strong, and if only half of them are long and you're only 50% long, then obviously your signal strength is not as strong. So that's really just a very simple way of thinking of it. It's it just reflects whether you have a lot of signals going in the same direction or whether it's more neutral in a sense. Nothing more fancy than that. So hopefully that's clear. Do you describe it differently, Moritz and Jerry, if you have lots of signals going in the same direction, or how do you think about it?
Yeah, I would see it just like you described, Niels. If you run multiple systems, multiple time frames, then that could be seen as signal strength, right? You make a 100-day high, you make a 200-day high, you make a 300-day high, right? So your position gets larger in aggregate. That would be my view of it.
Yeah, just in general, I'm just not a fan of signal strength as a concept. I think it. The way you describe it is okay, but it just gives off more of a predictive quality that if all 10 of my systems kick in, now we're onto something. No, you're not. You're not onto anything. We saw it last week, for God's sake. We're at all-time highs. I mean, how much we're cruising. And we get a biggest crash ever. It just means, I have a full commitment, all 10 of my systems, which just have different look-back periods. They're all long. I mean, in some ways, as a kind of a cowardly risk manager, I'm like, oh, God, I'm all long. I'm really in this thing now. I'm not excited about it any more than any other trade, but I know it's going to could possibly really sting me if it reverses. So and then I think the whole idea that you should sort of use relative strength or look at, the whole point of the problem with the trend following idea is that, you have this really good strength in the sample size, but you've got to get the sample size. And so the things that you have to do to get the sample size is to not use relative strength and not sort of have this idea that, just buy the strongest and sell the weakest. No, you've got to have this kind of approach that gets you in lots of trades that so you don't miss any big outliers, and most of them turn around and don't make money even after you get all loaded up and all your systems are long. So it's really, I think, just a false impression that more trend is going to lead to higher performance, which doesn't really happen, I think.
No, I mean, I think that's a fair point. Of course, it doesn't say anything about whether it's going to be a good signal or not. So it is a reflection in terms of exposure, I guess, and then we'll find out later whether that was a good thing or a bad thing. All right, let's move on. We're going to go to I think Africa this time. Jonathan writes in, and he writes something like, I have a deceptively simple question. Perhaps it really is that simple. In all of the wonderful discussions I've heard on the podcast, I'm now convinced and starting to investigate ways that I can develop a universal trading system for trading all markets with the same parameters. Choosing a universal protective stop across multiple markets is harder than I thought, though. The simplest approach is to set it to a fixed number of bips or basis points, or a fixed dollar loss, or even current price less a percentage. However, I've been thinking, if you're willing to weight the position size for a particular market based on volatility, then surely we need to set the downside proportionally as well. So do you guys do something like setting the stop based on ATR, or perhaps use another complicated approach? Now, since we don't use stops, I sent it straight over to you, Moritz. This is right up your alley, I'm sure.
Yeah, I use ATR, so the initial stop is offset by a certain number of ATRs from the entry price, and the position size is then calculated that if that stop got hit, it would lose a certain amount of equity of my account. That's how I do it.
I agree.
Same concept, Jerry?
Yep.
Yeah.
I think ATR is wonderful. And based on your number of ATRs, that make sure they're not too close to the market. Your small losses are not too small. You just get chopped up. And but I think using percentage retracement and things like that is definitely something to stay away from.
But if I can dig a little bit deeper here, guys, because maybe this is useful. ATR can change, right? It can expand. So do you also use rules whereby your initial stop can't be, it can't be, if it's a long trade, it can't go lower than a certain initial level as you are in the trade? I mean, just to help maybe out a little bit here, because ATI, if that doubles, you don't want to necessarily take twice the loss. So how can Jonathan think about using ATR, but without that risk?
I think you want to distinguish the initial stop and then any subsequent trailing stop here. What I was just explaining was the setting of my initial stop, right? So that one's in. Now, as the trade develops, if I'm lucky enough to stay in the trend and it's moving in the direction I want it to move, then the stop will start to change eventually. It will trail over a certain, whatever the rules are that I've given that stop to trail, right? But yes, I do have a hard rule, which means that the stop will never go down. I do not allow the stop to go down. So I floor it at the initial stop level. It can go higher, but not lower. And then as the trade develops, maybe at some point there will be more ATRs at risk than I initially risked, but the stop will never go down.
And this is, of course, on a long trade we're talking
On a
about
long
here.
trade.
Yeah.
Yeah, so I do the same thing. So you have your initial stop loss. That doesn't change. You place it. You use the ATR on the day of entry, and then the more traditional breakout and moving average, which is not based upon ATRs, kicks in. Hopefully, if the market turns profitable, the trade turns profitable. So that's the old-fashioned way, and limiting those losses. And I looked at some research the other day that proved my memory correct, that at some level of an ATR loss, a reasonable level, using stops and not using stops, the results are about the same. The average loss, with or without stops, is about the same. And so all the stops really do is keep the losses, max at a certain level. It doesn't go above, but not having stops seems to be fine. Historically, I think it's been fine. A week like this, you may say, yeah, I lost a little bit more because I didn't have these stops, and I would have preferred to use stops this week. But once again, we're frequently faced with these issues of, are you going to look at all the data and decide what you're going to do with your systems and your parameters on all of the data, or try to avoid one week of pain, or a couple of days of, where I would have lost less money. So I think the former versus the latter is probably the better choice.
By the way, one of the things that I want to say about the stops is, and it's just me, people may do it in different ways, but I do not have resting orders, stop orders in the market. So I observe synthetically where the stop is and whether it's been hit or not, but I will then trade on the next bar, the next day, whatever my system tells me to do, but I will not have stops sitting there in the order book waiting for them to get hit. It's like Jerry said, my analysis has shown that whether I have the stop immediately executed or whether I traded, say, a day late, long term, that stuff doesn't really matter that much. And it also allows me, it saves me time, because if I had stops working for me in the market, then if the stops changes, then every day I would either have to manually, or my system would have to do it, update the stop levels as the market develops, right? And changes price level. So I don't do that.
Interesting. I saw a funny comment actually regarding stops. Someone, I think, tweeted or wherever I saw it, saying something like, if you don't use market stops, then at some point the market will stop you trading. So,
yeah, in a way, I don't want to say I'm not using stops. I will honor the stop. It's just, I don't necessarily trade exactly at the stop price. It may have some slippage around that level, but I will. If the level has been hit, I'm going out.
Yeah. No, I think that makes sense. I think a lot of research shows that actually for longer term trend following programs, even if you delay your orders by a day, it makes no difference in the long run. Yes. So I agree with that. We have a completely different question from Craig, who writes in, "Hi Niels, hope you're feeling better after your recent cold that you mentioned in last show." Craig, I wish I could say so, but it's not quite gone, but there we are. "I had a hypothetical question about communication with clients. Let's assume your clients do not have access to daily performance reports, such as they only receive performance information from you when you communicate with them. How frequently would you communicate with them? Communication on a more frequent basis, weekly or monthly, may have the benefit of keeping the client well informed and aid the understanding, confidence in your approach, but it has the downside of reporting shorter periods of performance, which are more affected by randomness, potentially making the client more uncomfortable from time to time." I think that's a great question. I think it's something we all have to deal with. Jerry, what are your thoughts about communication?
Oh, so important, especially up front, that everybody understands what they're getting into and what they should expect, and then any sort of changes you have along the way, make sure those are properly communicated as well.
What about you, Moritz? How often would you share updates with your clients?
I think the industry standard has become the monthly update and the monthly fact sheet, regardless of whether people have a monthly NAV or a daily NAV. So there's always this monthly updated fact sheet. Honestly, I'd prefer it to be less frequent, to be honest. I mean, we've spoken about private equity and all of that stuff where kind of like there's a premium on being illiquid and not, see every print and every NAV all the time. I'd probably settle on something like your quarterly update and maybe a end of year annual letter that is a bit longer and reflects on what has been happening at the firm and what has been happening in terms of research and, how things have been developing and what the focus is on. But for a long-term trend following system, monthly updates are, it could be anything really. What I think is more important is what Jerry was saying is proper communication in advance. So prior to clients making an investment, speak to them. Be very transparent about what it is that your system is doing, your firm is doing, and that they need to be committed to that investment for a longer period of time. That the drawdowns will be there. That this is not the time to become shaky, but to stay committed. Like Jerry said, people need to understand what they're getting into. It's a good thing that they're getting into, but it's not easy to hold on to.
Yeah, I mean, a lot of good stuff in that response from Moritz. I think of it maybe a little bit differently. I agree with Moritz that long term, you don't want to encourage people to look at their portfolio all the time and all of that stuff. I agree with that, but I do things a little bit differently on my side. Firstly, I would say nowadays. Certainly if you're running a fund, that fund is often tracked anyways every day, and there's usually somewhere people can find the performance of the fund on a daily basis. Certainly US mutual funds, I mean, you can see the performance on your iPhone every day if you want, so they have a ticker. But on my side, and this goes for both my institutional relationships, but also high net worth individuals, I actually get up early every Saturday morning and I write them an email and I tell them what the performance is for the strategies, but I also put words on. And I think I do it partly because I look at what I would like to receive if I was an investor. And you can always say no, you don't have to receive these updates, but I see a lot of people actually wanting to receive them. I have more people receiving only monthly updates, but I have a lot of people actually receiving a weekly update. And so that's just how I've chosen to do it. But I guess it's very individual. I do agree that it's not useful in some ways, but it does put things into context. And then I completely agree with Jerry and Moritz and say the importance of investing time up front to make sure people know what to expect. Because frankly, people should be able to figure out more or less what our performance is going to be, not necessarily by percentage, but certainly whether it's a big up week or a big down week, just by reading the newspaper or looking at a screen. It shouldn't come as a surprise with trend following. You should know roughly how your manager systems react. So, but it's a good question, and I hope, Craig, it's not a theoretical question soon for you, that you will be doing it for yourself. Last question this week is from Russ. I think we're back in the States now. Russ writes in, loving the podcast. I've been a software engineer over a couple of decades and have developed some great models that I trade. I started my exempt CTA in January to start building an official track record. Since I'm small with little AUM, I'm finding it difficult to trade all the futures contracts markets because of the contract size. Micro products are becoming more popular and seem to have great liquidity. How did you handle this when trading your own retirement accounts or friends and family money as a small CTA? I guess back then, when we all started, we didn't have these micro contracts, and I don't trade them ourselves, but maybe you know more about how they are helping smaller, because I'm not exactly sure how small they are compared to the normal contracts, but I'm sure you guys know that, Jerry and Moritz.
So right now I'm not trading the micros. And like you said, Niels, when I started designing my system and my portfolio, that didn't even exist, I think. So the minis existed when I started,
Right.
in addition to the big contracts. And now the minis have become, in many instances, more liquid than the original big contracts. But the micros, I don't know. But what I have seen is that they are liquid. And so for the purpose that we're talking about here, running a trend following strategy on a smaller AUM portfolio, I think they're well suited to do that. And actually, so, use them. I mean, absolutely, use them. Get the diversification, right? Trade the smaller contracts, and I know they exist in the currencies, they exist in some of the equities, etc. Right? Maybe you can trade some ETFs as well to get exposure to some markets for which otherwise the futures contracts would be too large. What I want to say though is I'm actually right now working on a project to put a trend following trading system live on the web, online, for, I'm not sure, probably $100,000 or maybe $150,000, but not more than that, probably $100,000, and kind of like show that it's doable to trade in that way and to get the diversification, and it'll be with real money. So it's not, just trading a paper account, but actually real money. And then people can see if they like it, or if they want to copy some stuff out of it, they can just follow along.
Good stuff. Do you trade micros, Jerry, or do you trade just the usual ones?
Just the usual ones. Yeah.
Cool. So those were the questions. Quick recap, maybe, since it's month end today, but we still don't have the final day's performance. I think yesterday was kind of a mixed day. I have a feeling, depending a little bit on your market exposure, time frame, etc., etc. But as of Thursday night, at least, a small loss in the Beta 50 index for the month, down 34 basis points, flat for the year. Actually, small up for the SocGen Trend Index, up 22 basis points, up 1% for the year. Did I say SocGen CTA Index? That's what I meant, at least. SocGen Trend Index was also up as of Thursday night, about 1%, and 2% for the year. And the short-term traders index was up about 58 basis points, but up 3%, so leading the charge so far this year. And the bridge alternatives was up just shy of 2%, and up about 1.4% for the year. But these numbers will change once we have the final numbers, but at least it gives you an indication as to what is going on. What else can we say? We can share that obviously we have, perhaps mentioned that we're going to have a guest on in a couple of weeks, Robert Carver. He has been on the podcast before as a long-form interview, but he's written a few great books, and he's very knowledgeable about this space. So if you have some questions specifically for Rob, then when you send the question to info@toptradersunplugged.com, if you could put in the headline, question for Rob, it's easier for me to keep track of those. So that would be good. That's coming up in a couple of weeks, so do send them in early. What else, Jerry Moritz, do you have on your mind, agenda for today?
It's been a long time since I've said it, but especially after that week, very important. Happy trading.
Okay, I would say even better advice, don't think about trading for a couple of days at least. So take some time off. This is have a happy Saturday.
Exactly.
Yeah, absolutely. And also, just want to repeat what I said last week, that we just want to make sure that that we don't take your attention for granted. And this journey that we are on is solely because you are gifting us your time and attention each week. So much love and appreciation to everyone out there who took a chance on the show and who have become part of this audience. It means a lot to us, and it's really your energy and enthusiasm and engagement with what we do that keeps us going. I think that's it for this week. From Jerry, Moritz, and me, thanks so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.